Hi, today I'm going to talk about something that is very important to investment markets and the economy. It's really poorly understood and it's changed a lot recently, and that is how money is created in the economy. 97% of money in the UK is in electronic form in the banking system, not in notes and cash. And actually the total of money over the last 27 years has grown 10.5% a year, which is much faster than the economy. And depending on how money is created, it has a very different effect on things like inflation, the price of assets like the stock market and property, and financial stability. So as investors, it's really important that we understand it. So the first way is the central bank creates money and it buys existing government bonds. That is called quantitative easing, or QE. The second way is central banks create money, but they directly finance government deficits. And the third way is a bank creates a loan, because every time a loan is created in a country like the UK, there's an increase in the money supply. So if we look at each of those in turn, and we look at the effects that they have, it becomes a bit clearer as to why we care about this so much as investors. So if you look at QE, so QE is something that was reintroduced. It's a very old process. It's been known about for a long period of time, but actually hadn't been used for almost 100 years. And it started again in 2008 after the global financial crisis. And central banks became very aggressive at intervening in the economy using this thing called QE. And what they do is they create money at the central bank and they go out and they buy government bonds in the market. Now, at the time, everyone thought that this amount of money creation would be very inflationary. But actually, technically, the money that's created was sterilized within the banking system. And I'm not going to go into the detail of that today because it is quite technical. But the effect was clearly, and the reason people did QE was to try and by buying bonds in the market to reduce the yield on long-term government debt. So it was a stimulus to the economy. And if you stand back and look at what the real impact has been, there probably has been inflation, but not in terms of the price level. It probably had quite a big impact on the price of assets, so property and the stock market in particular. The second form of money creation is this where central banks directly fund government deficits. And this is something that we saw during COVID. The deficits ballooned to the extent that governments couldn't really finance them by selling bonds in the public markets, so central banks stepped in to buy them directly. Now, this is highly stimulative, and there isn't any way that you can control this within the banking system to reduce the stimulation. So actually, you ended up being highly inflationary in all of the economies that did this, and we've seen that over the last 2 to 3 years. And of course, once central banks have done this once, it's always more likely they might do it again. So it is something that we have to watch out for. The third thing, which is important and is important over a much longer period of time, is actually how loans are created and the impact of that. So most people, when they think of a bank loan, imagine in their mind that the bank has money and then it decides it's going to give that money to you in form of a loan. It isn't how it works. If you take a bank loan out, actually what happens is the bank creates money electronically to create that loan, and then you are given the money, and then you use that money to buy an asset or service, and the person you buy it from ends up with the money that the bank created. So every loan that is created increases the money supply, and that money supply is only reduced when the loan is repaid. And as we've seen over the last 30, 40 years, bank loans, the rate of indebtedness has grown much faster than the economy. So the bank loans themselves have been a big source of money growth. Now, this has been a significant positive for the economy. It's driven up asset prices, but it's also driven up economic activity. But it's come at the cost of some, I would say, in terms of financial stability. Because the higher the debt levels in the economy, the more fragile and the more unstable the economy is. So as investors, what does this all mean and what do we care about? Well, realizing how important money creation is for asset markets and investment and inflation, we have a keen eye on all of those three things. So if we think central banks are about to start monetizing deficits, paying directly for deficits again, we know this is likely to be inflationary, and we will try and take action ahead of time again to protect ourselves from that. Similarly, if we think that the central banks are likely to reintroduce QE, quantitative easing again, we know this is quite likely to be stimulative for economic growth and asset prices. But the big one, actually, as investors that we need to watch out for, that isn't commonly understood by most investors, we think, is this direct impact of loan growth and the economy. So if for any reason loan growth decelerates in countries like the UK and the US, either because the banks aren't able to extend the loans, or because borrowers themselves don't want to continue growing borrowing, then we are likely to see a direct impact on the economy in pretty short order. The bonds are likely to rise in value as yields decline, and the equity market is likely to come under pressure. As always today, I've been talking about investing, so I must remind you that your capital is at risk. If you like these videos and you want to subscribe to them, please click on the flying colours icon at the bottom of the screen, and that will automatically be added to the list. And lastly, if there's anything I've talked about today that raises some questions or you'd like more information about, please contact me directly by email or telephone, and I'd be delighted to speak to you. Thank you.